In this video, I'm going to show you the 5-step checklist that I personally use to research and pick my stocks to invest in. So if you are a beginner trying to research your own stocks, I would encourage you to follow these 5 steps because it will give you a better chance at picking quality companies that will perform well for you in the long term. And if you're anything like me, you're always busy, so I'll throw in a few bonus tips on how to save time with your research. Let's get started. The first step is to understand the company. This is one of Warren Buffett's golden rule. He has mentioned many times to never invest in a business you cannot understand. And of course, he's absolutely right. There are thousands of companies out there that you can invest in. So you are more likely to get a better return if you have an intimate understanding of the company you're interested in. And preferably, you are already a customer of this company, so you are familiar with the products or services that they sell and how they make their money. So for instance, Apple is a great example because chances are you probably own an iPhone, MacBook, or one of their many popular devices. Therefore, since you are already familiar with their products, you'll be more encouraged to do further research on the company. You want to avoid complex companies that you have no idea what they do and how they make their money. When I first started investing, and I use the term investing very loosely, let's be honest, it was more like gambling because I was not doing proper research at all. I just went by what other people were telling me to buy and what strangers were recommending on the internet. I didn't know, nor did I care what the company was doing. All I cared about was stock price go up and when Lambo. So if you're a beginner, please don't make the same mistake I did. Buying random stocks and hoping for a miracle is not a real strategy and has lost me a lot of money in the past. Your money is precious, so you need to research what the company does to see if they are worthy of receiving your money. So say you're an Apple user. You obviously like their products and services, and you're interested to learn more about the company and where they make the most money. Of course, you can just Google this and read a bunch of articles, but I find the best and most accurate way is to look through their annual reports. So go on Google and type in Apple Investor Relations. And by the way, you can do this for any company. Let's click the first link that pops up and scroll down. To get more technical information on their best revenue drivers, let's look at their 10K. The 10K is an annual financial report that every publicly listed company on the stock market must release in the US. And the report mainly contains all the financial numbers that you can use to better understand a company. If you scroll down to their revenue breakdown, you can see that iPhones bring in the most revenue by far. Then you have the Macs, iPads, wearables, home, and accessories. Now the most interesting thing I noticed is their services. As you can see, they have steadily increased their services revenue every year, and this could be a future indicator that services can become their leading revenue driver. So Apple services includes iCloud storage, Apple TV, music, games, books, fitness, and many other apps. You may have noticed the world around you has become very subscription-based these days. We have to pay monthly subscriptions for storage, TV, music, amongst other things. And it is clear that Apple wants a big slice of this pie. So as an investor, you keep notes of things like this. Take the time to truly research and understand the company. The next step is to consider the company's financials. This is the part where you should spend most of your research because you're trying to find out if the company is financially healthy. You don't want to invest in a company on the verge of bankruptcy. So before we talk more on this, you need to understand there are generally 2 types of stock analysis. There's technical analysis and fundamental analysis. Technical analysis involves studying charts to identify trends and patterns gathered from trading activities like price movement and volume. Ooh, that was a tongue twister. It involves using short-term trading activity to predict future price movements. This method is mainly used by day traders or short-term investors who want to make a quick profit by getting in and out of stocks. This is something I would not recommend for most of you, especially if you are a beginner. It takes a lot of skill to be a successful day trader in the long term, and very few manage to make a career out of it. In contrast, fundamental analysis has a larger focus on a company's financials rather than the historical price patterns. And this is what we'll be focusing on in this video. Fundamental analysis examines the financial health and economic factors of a company to determine the stock's fair or intrinsic value. Intrinsic value is the true price a stock should be worth according to its financial. The end goal here is to determine if the stock is undervalued or overvalued. This is the approach most long-term investors use, including myself. So with the company's financials, there are 3 important financial statements you should focus on. The balance sheet, income statement, and the cash flow statement. As an accountant myself, I can confirm these 3 statements are the holy trinity of accounting statements that determines the financial health of a company. Now we can access a company's financials in 2 ways. The first way is to go directly to the source, which is the company's investor relation website. So if we go back to the Apple website, we can access the financial data from the quarterly earning report or the 10K, which we were looking at before. All the financial information we need should be in this report. However, I find these reports quite long and sometimes the information I want is spread out all over the place. So I end up wasting a lot of time scrolling through pages trying to find what I want. So to save myself a lot of time, I use the Moomoo app to do most of my research. I already use Moomoo to buy my US shares anyway, so it makes it super convenient to just whip out my smartphone and start researching stocks I'm interested in. If we open up the app, we can look up the balance sheet, income statement, and cash flow. As you can see, the data is presented in a more organized way with graphs, making it easier on the eyes. Whereas if you were to pull up the 10Q quarterly report or 10K annual report, it gives you a bunch of numbers in a box and you would have to manually convert that into graphs to make it more digestible. You can compare the current quarter to the previous quarters, and you can also change the period settings to annual so you get a year-by-year comparison. There are also many popular key financial indicators that professional analysts use, which are all ready for you with a click of a button. And we will further discuss these financial indicators later in the video. Speaking of professional analysts, they also offer analyst ratings and institutional tracker, which shows you a glimpse of what the professionals are buying or selling. So you can see what the big institutions like Warren Buffett's Berkshire Hathaway are doing. So instead of paying for a third-party membership for these analyst ratings, it is already included in the Moomoo app. Now, you shouldn't decide to invest in a company solely based on analyst ratings, but it is important to understand the influence of these analysts and institutions. For example, last month when Morgan Stanley upgraded Tesla's target price, its share price went up 10% immediately. So it is a nice little function to have all in one app. And like I mentioned before, I already use Moomoo to buy my US shares, so it saves me so much time to do my research in the same app. If you're interested in using the Moomoo app, you can click the link in the description to sign up. And if you deposit any amount, so even $1 will do, you will get 180 days of free brokerage fees for both US and Aussie stocks. You will also get full access to all the research function that I just mentioned. And if that wasn't enough, Moomoo are currently offering a promotion where you can receive up to 15 free shares worth up to 6,100 if you deposit a certain amount of money and keep it in the account for 30 days. I'll put all the details on the screen here if you're interested in trying out Moomoo and getting some free shares. Let's now go through the 3 financial statements. We'll continue to use Apple as an example. So we can open up the app and search for Apple. And there it is. Let's click Company. And you'll be able to find all the financial information and metrics all in one spot. Let's start with the balance sheet, which contains the company's assets and liabilities. So as you can see, it's got all the data sorted per quarter, and we have a graph that visualizes each quarter. Now you can choose to change it to annual so you can compare year by year. An asset is a resource owned by a company with the expectation that it will provide a future benefit. So simply put, assets good, liabilities bad. So Apple's total assets is 335 billion for this quarter, which increased by 3 billion from the previous quarter. Let's now move on to the liabilities. A liability is something a company owes which should be settled over time. It could be debt or something costing the company money. So the total liability has increased compared to the previous year, which isn't good, but it's not necessarily an automatic red flag. There could be a reasonable explanation for that. For example, Apple could have borrowed money to fund a new factory or location. While this may increase the liability temporarily, Apple may increase their future profits from doing this. So it could be short-term pain for long-term gain. In general, a company's total assets should be higher than total liabilities, which it is in Apple's case. There is also a calculation we can do to see if a company is at risk, which is called the current ratio. The current ratio is the current assets divided by the current liabilities. The current liabilities are all debt that needs to be paid within 12 months. So if we divide the total current assets by total current liabilities, we get 0.98. If you don't want to calculate this yourself next time, you can go to Financial Indicators on the Moomoo app and click Current Ratio. This will show the quick ratio compared to previous quarters. You can also change it to annual, which provides a year-by-year graph. Ideally, we want a ratio over 1 because this means the company has the financial resources to remain solvent in the short term. But we also don't want the ratio to be too high, as it may indicate that the management team are not using the assets efficiently. Usually anywhere from 1.2 to 2 is considered very good, but it depends on the industry. So in this case, since Apple's current ratio is below 1, it may indicate that they might have difficulty paying its debt, but this is not a critical problem for a company like Apple. If Apple has good long-term prospects, which it does, it may be able to borrow against these prospects to meet the current debt. However, if a company does not have a proven brand recognition like Apple, a current ratio under 1 may be a red flag. Of course, this one simple ratio does not mean anything on its own, so let's move on to the next part. Let's now look at the income statement on our app. The income statement focuses on the revenue and expenses of the company and how much net profit is made each quarter. The total revenue is the amount of money Apple generated from selling their iPhones, MacBooks, AirPods, and all the other products. The operating expense is the cost incurred as a result of performing the normal business operations required at Apple. So things like the running costs of their factories and the labor. You can work out how profitable a company is by calculating their net profit margin. Net profit margin equals net income divided by revenue. So using the data on screen, let's calculate the net profit margin for Apple. The revenue for this quarter is 81.8 billion and the net income is 19.88 billion. So the net current profit margin for Apple is about 24%. And of course, to save time, you could look up net profit margins in the financial indicators on the app. But it's good to understand how to get to this number in the first place. So what does the 24% mean? Well, this means for every dollar generated by Apple in sales, the company kept about 24 cents as a profit. In general, a company with a net profit margin over 10% is considered okay, and anything over 20% is considered good. Although this does vary a bit across different industries. So it's easy enough to value a stock like Apple because it's already established and highly profitable. However, it's much harder to value growth companies which are not profitable and in fact losing money. And you might be wondering, why do people invest in them if they're losing money? And the reason is they are factoring factoring in future potential growth, which they hope will increase the share price. A famous example of this is Amazon. Believe it or not, they were unprofitable for many years before becoming a household name. The more recent example is Tesla, the electric vehicle company. In fact, Tesla was losing so much money in the beginning that they almost went bankrupt. And only recently it's been able to turn a profit for 3 consecutive years. Let's move on to the third important financial statement, which is the cash flow statement. A cash flow statement summarizes the movement of cash or cash equivalents that come in and out of a company. It measures how efficient a company manages its cash position by generating enough cash to pay its debt obligations and fund its operating expenses. Let's find the cash flow statement in the app. And with this statement, I prefer to look at the annual numbers to compare each year. So we can change it by clicking this tab and switching it from quarterly to annual. The cash flow statement is broken into 3 areas: operating activities, investing activities, and financing activities. However, I don't like to waste too much time here. The number I'm interested in the most is the free cash flow. This is the company's available cash, which can be used to repay creditors, pay dividends to their investors, or buy back shares, which is great if you're already an investor, as it increases the value of each share. I like to check that the company is increasing its cash flow year over year, which Apple is doing. The free cash flow represents the health of the company. So now that we've looked at the 3 key financial statements, let's move on. The next step on the checklist is to remember that valuation matters. The share prices that you are used to seeing on the screen can be fake. That is not the true value of the stock. Sometimes it becomes a popularity contest. The share price does not always represent the true value of a company. So it's up to us to work out the true value of a stock before investing. Now that we've looked through the financials of the company, we are more familiar with some of the terms. We can now use this knowledge to look at some popular financial metrics and indicators to value a company. These metrics will give us an idea if the company we are researching is overvalued or undervalued. Let's start with earnings per share, or EPS for short. EPS indicates how much money a company makes for each share of its stock. It is used as an indicator of how profitable a company is. EPS is calculated by dividing a company's net income by the outstanding shares of its common stock. Again, we can find this on the financial indicators in the Moomoo app. So Apple's EPS in the last financial year was 6.11 and it has been steadily growing every year, which is a good indication that it will continue to do so. EPS measures how much profit is returned to the investor through its past performance. So ideally, you want a company that's been steadily growing its EPS over the years. The next financial metric is the price to earnings ratio, or the PE ratio for short. This is one of the most famous financial metrics to value a stock because it measures the market value of a stock compared to its earnings. Basically, the PE ratio determines what the market is willing to pay today for the stock based on its past or future earnings. So the PE ratio is calculated by dividing the share price by the earnings per share. If we look on the app, the current PE ratio is 28.77, which is around what the industry average is. This means investors paid around $28 for every dollar earned. On average, a PE ratio under 20 is usually good and the company is considered to be undervalued. However, it also depends on different industries. For example, it's not fair to compare Apple's PE ratio with Johnson & Johnson since they are in different industries. It might be normal for a pharmaceutical and healthcare companies to have a lower PE ratio. Instead, a fair comparison would be Apple versus Microsoft, where the PE ratio range will be more similar since they are in the same industry. PE ratios are best used to value more established companies where their revenue and profits are more predictable. The next financial metric is the price earnings to growth ratio, also known as the PEG ratio for short. The PEG ratio is used to determine a company's value while taking into account the company's expected earnings growth. The PEG ratio builds on the PE ratio by considering expected earnings growth and not just the current earnings. This type of metric suits a growth company that is expected to grow in the future. The PEG ratio equals PE ratio divided by EPS growth. So since different companies grow at different rates, the PEG ratio takes into account the expected earnings growth rate to level the playing field. So for example, let's compare 2 companies in the same industry. Company A has a PE ratio of 18 and company B has a PE ratio of 20. So if we just rely on the PE ratio, it would seem company A looks like a better option. However, let's say company A has an estimated 5-year earnings growth rate of 15% per year. Company B has an estimated 5-year earnings growth rate of 22% per year. So using the PEG ratio formula, company A has a PEG ratio of 1.2 and company B has a PEG ratio of 0.91. So now company B is looking better. This shows that when we take estimated growth into account, company B is actually trading for a discount compared to its value. This can be a great metric to use in cases where a stock's PE value seems excessively high. A PEG ratio value of 1 means there is perfect correlation between the company's market value and its projected revenue growth. A PEG ratio lower than 1 indicates the stock is undervalued because the share price is not currently accounting for expected earnings growth. And the PEG ratio higher than 1 indicates the stock is overvalued. So it's useful for you to know what financial metrics to use to value certain stocks depending on the industry or where the company is in their growth cycle. And there are many other financial indicators and metrics that you can research in the Moomoo app. So I would encourage you to scroll through this section and get familiar with some of these terms. And if you don't understand what they are, that's what Google's for. Trust me, if you put in the work, this will make you a better investor in the long term. The next step on the checklist is to look at the management team. You could have the greatest company in the world on paper, but if you don't have good people in charge, it won't do well. For example, Microsoft is a great company, but Bill Gates left as CEO in 2000 and appointed Steve Ballmer as the new CEO. And a lot of investors complained that under Ballmer's leadership, Microsoft got too complacent since they were basically a monopoly in the space and stopped innovating when he took over. Little did they know there was a small company called Apple, led by the ambitious Steve Jobs, in the background, ready to eat Microsoft's lunch. If you look at their stock price history, Microsoft were largely flat from 2000 until 2014 when the current CEO, Satya Nadella, took over. He immediately started to innovate and created new products like Azure Cloud, which created a new stream of revenue and is one of Microsoft's highest revenue drivers today. And under a new management team, Microsoft started to climb the ranks again as reflected by their stock price. So as you can see, a company is only as good as the leaders in charge. If you look at all the top companies in the stock market, they are led by some of the brightest minds. Would Apple be as successful as it is today if there was no Steve Jobs to lead them? When you think of Tesla, you think of Elon Musk. You have Jeff Bezos at Amazon, Mark Zuckerberg at Meta, Sundar Pichai and Google. The list goes on. So if you're researching a stock, Google who their management team is and see if they have a proven track record at their previous companies. The next step on the checklist is to work out the company's competitive advantage. This is also referred to as an economic moat by Warren Buffett. Competitive advantage is a single or multiple factors that allows a company to produce products or services better than their competitors. Usually it's something unique about a company that cannot be easily replicated by a rival company. For example, Coca-Cola's competitive advantage is their branding. Personally, I'm a huge Coca-Cola fan. I really enjoy Coke Zero and I drink it every day. Not recommending you do the same. But if I'm at the shops looking for soft drinks, I'm buying Coca-Cola. It's as simple as that. I'm not even considering Pepsi or any other soft drink brands. It's either Coke or nothing. Similarly, Apple has the same competitive advantage in their branding, plus they make quality products that works well and easy to use. They have managed to create such a perfect ecosystem where all their products play nicely with each other, and it's just so convenient to have multiple Apple products. Most people who start using an Apple product will probably never leave the ecosystem. For example, if my iPhone breaks today, guess what? I'm getting another iPhone. It's as simple as that. And it's probably the same for many other people given how many iPhones they sell per year. My iPhone allows me to send files quickly through AirDrop to my MacBook so I can do my work faster. It's improving my life and making me more efficient, so why would I switch? And yes, I am perfectly aware that Apple is keeping me as a prisoner in their ecosystem and their products are a bit overpriced. But using their products makes my life more efficient, so I'm happy to pay the premium. It is what it is. Another example of competitive advantage is Amazon's distribution network. They are able to store their products across multiple warehouses in many locations, so if you order a product from Amazon, you are able to receive it very quickly. I know personally, if I order something from Amazon, I'll have no issues with the shipping, and I can expect it to be delivered much quicker than if I were to order it from a rival company. An Australian example will be Wesfarmers, who owns Bunnings. Bunnings basically runs a monopoly for hardware goods in Australia. Their competitive advantage is the store network and their store locations, which are difficult to replicate. Over the years, I've seen many hardware stores trying to compete with Bunnings, and each one has failed. Back in 2011, Woolworths tried to compete with Bunnings with their own store called Masters, and this failed miserably because they failed to turn a profit and cease production in 2016. That is the power of having a competitive advantage. So those were the 5-step checklists that I use to pick which companies I'm going to invest in. I would recommend you follow these steps as well, especially if you're a beginner. At the very least, before investing in the stock, just relax and take your time in researching the company first. But I would say if you are a new investor, you should focus on diversification. So this means don't just go all in on a single company. You could do all the best research in the world, but the company can still go to zero. If that company goes to zero, you'll be left with nothing but regret. You need to manage your risk, especially at the start when you have little money. Consider investing in multiple stocks so that if one of them doesn't perform, at least there are others to prop up your portfolio. The easiest way to get diversified is to invest in index funds or ETFs that track an index. This allows you to invest in multiple companies all under one stock. And if you're interested to know how to do this, I'll leave a video in the description. So how do I invest? Personally, around 50% of my stock portfolio is made up of ETFs that track an index of the top companies in the Australian, US and other emerging markets like Asia. The other 50% is in individual stocks. And sometimes the allocation becomes higher or lower depending on how my stocks are performing. With these individual stocks, I'm not expecting them all to go to the moon. However, if 2 out of 10 can perform really well, it will more than make up for the rest. For example, I invested in Tesla stock relatively early, right before it broke out in 2020, and it increased my portfolio significantly. But generally, I try to keep the ratio around 50-50. But as I get older, I'll probably increase the ratio to have more ETFs as they are considered safer. And if you are a beginner, then you probably do want to have majority of your money in ETFs or index funds. Then as you become better at researching stocks, you can slowly build up a portfolio of individual stocks that has the potential to outperform the market average. And like I mentioned before, the good thing about having individual stocks is that you only need one of them to do really well for your portfolio to increase exponentially. And if you are interested in investing in stocks, click the link in my description to sign up to Moomoo. Once you deposit some money, either $1, you'll have access to their premium research tools, free brokerage fees for 6 months, and some free bonus shares. That's a pretty sweet deal. Having said all that, just a reminder, I am not a financial advisor and it is not financial advice. All the examples I used in this video are for educational purposes only and not buy recommendations. Please keep in mind that both stocks and ETFs are risky and nothing is guaranteed. If you would like financial advice, please go see a professional. By the way, if you made it this far into the video, I appreciate you, mate. Make sure you comment the word key down below so I know who you are. Also, if you're new around here, what are you waiting for, mate? Subscribe to the channel and come join this fantastic community. There are many more videos like this to come and you don't want to miss them. And if you'd like to learn more about stocks and ETFs, go check out this video on screen where I go over the pros and cons for each option and which one you should invest in. As always, thank you for watching, I appreciate you, and I'll see you in the next video.